Philip Morris International is one of the world's largest tobacco and nicotine products companies, selling iconic brands like Marlboro across more than 180 countries. While traditional cigarettes still represent a significant portion of revenue, PMI is rapidly growing its smoke-free and reduced-risk products, such as the IQOS heated tobacco system and ZYN nicotine pouches, which now contribute a meaningful share of both revenue and gross profit. What sets Philip Morris apart from peers like Altria and British American Tobacco is its global diversification and advanced position in smoke-free alternatives. Unlike Altria, which operates primarily in the U.S., PMI earns revenue worldwide, reducing concentration risk and exposure to a single regulatory environment. PMI's early and extensive investment in smoke-free products has given it a competitive edge over Altria's slower transition. Compared to British American Tobacco, PMI has built a more focused presence in heated tobacco and oral nicotine products, supported by global scale and a strong balance sheet. These factors combine to make Philip Morris one of the most compelling tobacco stocks today, offering both stability from legacy cigarette cash flows and growth potential from next-generation products. Now let's look at the key risks facing Philip Morris International. Regulatory risk is the most significant. Tobacco and nicotine products face heavy regulation worldwide, including potential tax increases, advertising restrictions, and plain packaging laws, which can impact profitability. Litigation risk is also notable. Past and potential lawsuits related to the health impacts of smoking could result in fines or settlements. Competition in smoke-free products is increasing. PMI's IQOS and ZYN face rivals from BAT, Altria, and independent vapor and oral nicotine brands, which could slow adoption. Currency and macroeconomic exposure is another factor. With operations in over 180 countries, PMI is sensitive to exchange rate fluctuations, inflation, and geopolitical risks. Declining smoking rates globally present a medium-term risk to legacy cigarette revenue, though PMI is addressing this with next-generation products. Finally, supply chain disruptions pose a minor risk, as shortages of tobacco, packaging, or logistics delays could affect operations in key markets. While Philip Morris International has become a leader in next-generation nicotine products, its journey over the past 5 to 10 years hasn't been without missteps. The company pursued multiple R&D and business diversification efforts, including e-cigarettes, vaccines, and even insurance offerings, that ultimately did not materialize into sustainable revenue streams. These ventures were costly and diverted focus from core growth areas. PMI also set ambitious internal targets, such as becoming predominantly smoke-free by 2025 and generating significant revenue from beyond nicotine products. However, these goals were not met and, in some cases, criticized as aspirational rather than realistic. Geopolitical and market risks also emerged. Heavy exposure to markets like Russia and Ukraine created significant challenges during the Russian-Ukraine conflict, while legal setbacks, such as restrictions on IQOS sales in the U.S. due to patent issues, slowed expansion in key regions. There have also been controversies around product claims, including debates over nicotine content in IQOS. Meanwhile, cigarette shipment decline targets stalled, and some financial reports showed pressure on operating cash flow and debt due to ongoing investment in new product lines. These experiences illustrate that even a dominant industry player like Philip Morris has faced strategic, regulatory, and operational challenges along its transformation path. Looking ahead in 2026, Philip Morris has multiple opportunities to drive growth and shareholder value. The top opportunity is the global expansion of IQOS and other smoke-free products, which can replace declining cigarette revenue while delivering high margins. PMI's leadership in this space positions it ahead of competitors. Emerging markets growth is another significant opportunity. As disposable incomes rise in Asia, Eastern Europe, and Latin America, more consumers are willing to switch to premium or smoke-free alternatives. PMI's pricing power and strong cash flow from its legacy brands provides resources to invest in research, innovation, and shareholder returns. Additional opportunities include M&A and strategic partnerships to accelerate growth, gaining regulatory recognition as a harm reduction leader, and ESG initiatives to strengthen brand perception among socially conscious investors. Overall, while some opportunities carry moderate risk or slower financial impact, the combination of global scale, innovation, and strong cash flow makes PMI one of the most attractive tobacco stocks today. Now let's review Philip Morris key financial metrics. Over the last 10 years, the stock has delivered a 10-year annualized return of 11.9%, including dividends reflecting both growth and reliable income. The P/E ratio stands at 30, indicating a relatively premium valuation, while the beta of 0.42 shows the stock has low volatility compared to the broader market. From a leverage and efficiency standpoint, EV to EBITDA is 16.1 and net debt to EBITDA is 2.5, which demonstrates moderate leverage. Return on invested capital is exceptionally high at 31.65%, highlighting PMI's ability to generate strong returns on its invested capital. Profitability is impressive. Gross margin is nearly 67%, and net income margin is 21.5%, reflecting strong pricing power and operational efficiency. The price to free cash flow of 25.5 indicates the stock trades at a premium relative to cash generation, but given PMI's stability and growth potential, it is justified. Overall, these metrics illustrate a highly profitable, low-volatility company with solid returns and strong cash flow, reinforcing its position as a leading global tobacco stock. Finally, let's look at Philip Morris dividend profile. The stock offers a dividend yield of 3.55%, with a payout ratio of nearly 98%. While this is a high payout relative to earnings, the dividend is still supported by strong and consistent cash flow, making it attractive for income-focused investors. In summary, Philip Morris is a global leader in the tobacco industry, with strong brands and rapidly growing smoke-free product lines, such as IQOS and ZYN. The company generates stable cash flow, maintains high margins, and exhibits low volatility, making it a defensive investment. The dividend is compelling, but investors should monitor its sustainability given the high payout ratio. Overall, the combination of a stable dividend and growth potential in next-generation products positions Philip Morris as one of the most attractive tobacco stocks in 2026. If you found this analysis useful, don't forget to like the video and subscribe to the channel. Your support helps grow this investing channel. Thank you for watching and see you in the next